Toni was 23, had a little money saved up, and just discovered the stock market. Not the boring kind, not the slow, steady, boring kind. The exciting kind, the kind with fast charts and green numbers and Reddit threads that say this is the one. And honestly, Toni felt smart, like unusually smart. Because in the first 2 weeks, Toni made money. Not life-changing money, but enough to go, wait, is it this easy? Spoiler, it was not this easy. And the mistake Toni was about to make isn't rare. It's not even unusual. It's the default move almost every new investor makes in their 20s. It feels completely logical. It feels responsible even. And it quietly sets you back years. So before this turns into a regret, think twice, Toni. Let's rewind a little. Toni had just landed a full-time job, first real paycheck, first time ever having actual money that wasn't immediately spoken for. And Toni did what a lot of people do when they suddenly have money and a Wi-Fi connection. Started watching finance videos. And look, some of those videos are genuinely helpful. Some of them. But here's the thing about finance content. The most useful advice? It's kind of boring. Index funds, long-term holding, compound interest over decades. The least useful advice? Incredibly exciting. Specific stocks, hot sectors. This chart is showing a breakout pattern, said with complete confidence. Toni, understandably, gravitated toward the exciting content because boring advice feels like it's not doing anything. Exciting advice feels like it's working. So Toni made a plan, or at least what felt like a plan. Step 1, pick a few promising companies. Step 2, invest money in those companies. Step 3, watch the money grow. Simple, clean, logical. Except there's a step that's missing, a huge one, and most people don't notice it's missing until way later. Here's the thing nobody tells you clearly when you're starting out. Investing isn't just about picking things to invest in. It's about knowing why you're investing, when you'll need the money, and how you'll handle the moments when everything drops. Toni skipped all 3 of those questions. And it's not because Toni was careless, it's because those questions don't feel urgent when you're excited. They feel like homework. So here's what actually happened. Toni put a chunk of savings, real savings, into individual stocks, companies that felt solid, companies people were talking about, brands Toni actually knew and used. And for a few months, it was fine. Then one of the stocks dropped 30% in a week. Not because the company was a scam, not because anything catastrophic happened, just because the market moves. It always moves. And here's where the first big problem appeared. Toni panicked, sold, locked in the loss. Classic, incredibly common, not a personal failure, a predictable human response to watching a number you care about drop fast. But here's where it gets more complicated. A few months later, that same stock had recovered and gone up even more. And this is the part that quietly does the most damage. It's not just the money Toni lost by selling low, it's the mental spiral that followed. Maybe I'm not good at this. Maybe I should just stick to a savings account. Maybe the market is too unpredictable. All completely understandable thoughts. Also, all based on a misunderstanding of how investing actually works.
Here's the thing that Toni and most new investors don't fully understand at the start. The stock market is a long game, not a medium game, a long game. And when you invest money you might actually need in the next year or two, you've already changed the game without realizing it. Money you might need soon belongs somewhere safe and accessible. A high-yield savings account, a money market fund, somewhere it's not going to be down 30% right when you need it. Money you genuinely won't touch for a decade or more, that's where the market makes sense. Not because it always goes up short-term, it doesn't, but because historically, over long periods, it tends to. The mistake isn't investing. The mistake is investing without first asking, what is this money for and when will I need it? Second thing Toni needed to understand, individual stocks versus index funds. This one sounds complicated, it's really not. An individual stock is a bet on one specific company. An index fund is basically a bet on a whole economy. When Toni put money into a few specific companies, Toni was betting on those specific companies doing well. That can work, but it requires knowing those companies really well, their finances, their competition, their debt, their leadership. Most new investors, understandably, don't have that information. They have vibes and brand recognition, and vibes are not an investing strategy. An index fund doesn't require you to pick winners. You're buying a little piece of hundreds of companies at once. Some of those companies will fail, some will explode. The idea is that across all of them, the overall trend is upward over time. Less exciting than picking stocks, way more consistent for most people. And here's the thing that took Toni a while to accept. Simple is not the same as lazy. Simple investing that you actually stick to outperforms complicated investing that you panic sell the moment things get rocky. Okay, here's the part that actually matters more than any stock tip or fund recommendation. Investing is mostly a psychology problem. The information isn't the hard part. The hard part is what you do with it when things feel uncomfortable. There's a concept called loss aversion, and it basically means this. Losing $100 feels about twice as bad as gaining $100 feels good. And that's not a character flaw, that's how human brains work. But in investing, that instinct works against you. When markets drop, the uncomfortable feeling pushes you to do something, sell, move the money, make the bad feeling stop. When markets are climbing, the exciting feeling pushes you to do more, put in more, don't miss out. So the average investor ends up buying high when things feel exciting and selling low when things feel scary, which is literally the opposite of what you want to do. Not because people are dumb, because they're human. The best protection against this isn't more knowledge about stocks. It's simpler system with fewer emotional decision points. Automate the investing. Keep it boring. Don't check it every day. Toni eventually learned this, but it took losing money, panicking, selling, watching it recover, and spending a few months feeling like an idiot. You don't have to take that route. So what would Toni do differently now? Before putting any money into any investment, Toni now runs through 3 questions, just 3. Question 1, when might I actually need this money? If the answer is within the next 2 years, it goes somewhere safe, not the market, a high-yield savings account, something liquid. If the answer is, honestly, not for a decade or more, okay, now we can talk about investing. Question 2, how would I feel if this dropped by 30% tomorrow? Not could I survive it mathematically, how would you actually feel? Because if the answer is, I would panic and sell, you probably have too much in there. The amount you invest should be an amount you can emotionally ignore during a downturn. Question 3, am I investing or am I speculating? Investing means buying something with a reasonable expectation of long-term value growth. Speculating means betting on a short-term price movement. Both exist, both have a place if you know what you're doing, but they require completely different approaches, and most people speculate while thinking they're investing. None of these questions are complicated, but most people skip them because they feel less urgent than just clicking the buy button. Toni learned the hard way that the questions are the whole point. Look, Toni didn't do anything catastrophically wrong. Lost some money, learned some things, made better choices after, but the version of Toni who asked those 3 questions first, that version would have saved months of stress and a pretty meaningful chunk of money. The investing move that feels smart in your 20s, putting money into exciting things with confidence and no real framework, is genuinely understandable. Everyone around you seems to be doing it. Some of them are doing great. The ones who aren't usually don't post about it. The actual smart move is slower, more boring, less impressive to talk about at parties. But it works. And more importantly, it doesn't put you in a position where you need everything to go right now to be okay. So before you hit that buy button, run the 3 questions. When do I need this? Can I emotionally handle a drop? Am I investing or speculating? Still want to go ahead after those 3? Then go for it. Just don't skip the questions. That's it from Toni. See you in the next one.